So you've started investing in some broad-based ETFs that you're hoping will build your wealth over time. That's the rosy scenario that most YouTube videos talk about, but very few talk about the tax considerations going into these kind of investments. And that's a whole other kettle of fish. In this video, I'm going to cover the 5 ETF tax mistakes costing Australians thousands and the one-stop solution that solves all of them. The first mistake is using FIFO without realizing the impact. A lot of investors and a lot of accountants default to just using the FIFO strategy when calculating capital gain. FIFO stands for first in, first out. When you have bought into a share multiple times, say you were doing dollar cost averaging, and then you sold some of it, the way you calculate the gain with FIFO is using the first shares you purchased first and then working your way through the different share parcels. Now the ATO is really good in that it lets us have the flexibility over how we want to calculate our capital gain. And so there's FIFO, there's LIFO, and those are the two you might have heard about. But then we've got max gain, min gain, and minimized CGT. So let's jump into Navexa, and I'm going to show you an example of how these different strategies dramatically affect the capital gain. Here in Navexa, we've got a portfolio with a few of the usual ASX suspects in it. I want to take a look at this BHP holding to show you that we bought it back in 2018 for $33. We had a bunch of dividend reinvestment trades come through, and then we sold it in the 23-24 year for $41. So 41 versus 33, capital gain. If we go to the capital gains tax report, we can see up the top here that for that year we realized a $13,124 capital gain. And you can see here the 2 BHP parcels that we've sold. You can see the cost base, the sale value, and the ultimate capital gain that we received. But what if we wanted to reduce this tax bill by using a different CGT strategy? So we can come in here, and instead of doing a FIFO, let's try a minimized CGT strategy. Now our $12,000 or $13,000 gain is now only $4,300. But how did we do that? Well, you can see now we have a whole heap of other BHP records here. We have some capital loss records for BHP here. Now, how does that work? Well, going back to our BHP trades, you can see that when we did a FIFO and we were selling 430 of the quantity, back here, our first trade ever, so first in, first out, we bought 2,500. So it would have calculated a capital gain from the $41.980 through to off the $33 that we bought it for. When we changed it to minimize CGT, instead of selling this one, it's going to prioritize the parcels first that result in the lowest capital gain tax figure. So you can see we have all these other parcels to play with, and we've got one here for $51. So from that 430, we would have sold 148 of that, which leaves us with still a couple of hundred in quantity. This one's $46, so maybe we sold 119 of that. And then it goes through and finds the next highest parcel and sells that first. So that means because we have the flexibility in how we calculate the capital gain, we can actually use algorithms like this to select the appropriate parcels to achieve the tax result that we're looking for. Now, of course, once you sell off all of your high-priced parcels, you are left with everything else. So next tax year, if you try to run a minimized CGT again, it will only have the lower price ones to choose from. You'll have to realize those gains at some point. It helps if you can plan ahead with what you want to do with tax. If you know that this particular year you want the smallest tax bill, maybe you'll do that. Maybe you want the biggest tax bill because it was a lower income year for you this year. So you might run a maximized gain strategy. The choice is yours and what the goal that you're trying to achieve is. The second big mistake for ETF investors is not tracking the AMIT cost-based adjustments. Now that sounds like some crazy term, but every year around July or August, you'll receive your member statement. And on that statement, there'll be a whole list of line items. It's honestly quite boring to read, but is very important because while a lot of that data does get pre-filled to the ATO, there's a couple of line items that you need to pay attention to, and they're not sent through to the ATO. And this is the cost base increase and decrease line items. Now, what that means is if you've been buying into an ETF for the last several years, perhaps you've been dollar cost averaging every month for the last 3 years. So you've got 36 different parcels. When you receive the dividends or the distributions from the ETF this year, they'll send you the member statement, which has a cost base adjustment. What you're supposed to do with this adjustment is calculate the pro rata adjustment across all of those 36 parcels. So if it's a cost base increase, all of your 36 parcels need to be slightly increased proportionately. Similarly, if it was a cost base decrease, then the cost base has to come down. Now, most ETF investors I speak to have no idea this is a thing, let alone how to calculate it. And it actually often results in people paying way more tax when they go to sell some of that ETF. Now, I hear what you're thinking. You think, I'll just worry about it when I sell. But if you're buying into this ETF, particularly if you're dollar cost averaging, it's going to be an absolute nightmare trying to retrospectively apply those adjustments when you've got 50 to 100 parcels to do it on. And each year, this problem compounds because each year you get these adjustments which affect every single parcel that you own before it. Now, there's a couple of other line items on that member statement which also aren't sent through to the ATO, and they are the capital gain sections. So part of the ETF chopping and changing out of different positions can incur a capital gain, and that gets passed across to you as the individual. So even though you might not have sold any of your stocks or ETFs this year, you can still have a capital gain resulting from what the fund did with your ETF. So you need to pay attention to those lines because they're also not pre-filled, and they can also have a big impact on your capital gains tax report. The third mistake is failing to harvest losses. Now, what a lot of investors don't understand is your capital losses can actually offset your capital gains. So when you're going into an end of year tax season, you have a particular capital gain, say you've sold a bunch of stuff and you've realized $1,000 capital gain, you can actually sell off some of your losers in your portfolio as well to offset that capital gain with capital losses and reduce your tax bill, hopefully to zero or hopefully into a capital loss, which you don't have to pay tax on. I'm going to show you in Navexa how we can use some of those tools and really quickly, with the click of a button, see exactly what we can sell to offset some of those gains. So we come to the tax overview anytime during the year in Navexa, and we can see what our current tax liability is based off the trades we've made. So we can see here that we currently have an $155 capital gain. Now let's imagine we're in June, right on the cusp of the financial year ending. And let's say we didn't want this capital gain anymore. What could we do about it? Well, firstly, we could run the unrealized gains report in Navexa. This particular report simulates if we sold everything today at the current market price. So what we can do is we can scroll down to the capital losses section and see that we have $521 of losses available that if we made these trades, we would realize. And if we realize 521, that would take our capital gain from before into a capital loss. So we might look at this and go, cool, if we make this BHP trade, it will give us a negative $437 loss, which would completely offset the $155 capital gain. The other thing we can do is go into Navexa AI and ask it, what if I sold $1,000 worth of my BHP holding? Navexa AI will go away and do its thing and then come back with what would happen if we sold $1,000 worth of BHP. It'll then give us the estimated tax liability of $84. So in this case, it wouldn't offset our gain, but we would be able to simulate making this particular trade and seeing what the result would be. The fourth mistake is terrible record keeping. Now, you need to keep meticulous records for all of your investing. As we've just covered in some of the other previous ones, things like cost-based adjustments have a massive impact. And when you're running strategies like the minimize CGT strategy for your capital gains tax, you need to be able to prove in the future exactly how you calculated the numbers. So if the ATO comes knocking and asks for proof, you need to be able to prove that with solid record keeping. Now, a lot of the older methods like keeping it in a spreadsheet just are not going to cut it anymore, because as you're investing more and more and dollar cost averaging, or you have DRP on, or you're just chopping and changing out of different things, you're going to have a lot of records you need to keep track of. And it's really important you keep these for a long time. The other problem people have is when they change brokers, every time you shift holdings from one broker to another, they don't send the trade history with it. They just send, you own 100 of this stock, but it doesn't send across all of the different parcels that you use to buy that 50 and 100 shares. The benefit of keeping good records using a tool like Navexa, for example, is no matter which broker you move to, it doesn't matter, because all of your records are in the one place. So let's take a look at Navexa. I'll show you exactly what I mean. So here in Navexa, we've got a portfolio with a bunch of stocks, cash, crypto, custom investments, managed funds, and some US shares as well. And if we take a look at the CBA holding, for example, and we go to the trades tab, you can see our original buy trade back in 2018 we made on the NAB trade platform. And then somewhere in the years between 2018 and 2024, when we sold it, we moved all of these shares to ComSec and we executed 300 of that sell trade on ComSec. And then not long after that, between 2024 and 25, we sold more of that stock, but this time we sold it on Perla. So if you don't know, every time you move brokers, you don't get the trade history moved across. So it makes calculating tax and performance really difficult. Having all your records here in Navexa means that you can move to as many brokers as you want. If you want to chop and change through brokers every year, you can do that, and you know that all of your records here are kept nice and tidy. The other aspect to record keeping that's really important, and this stock highlights it really well, is you can see we bought this back in 2018, and look at all of these dividend reinvestment parcels that we've received in that time. Each one of those giving us more quantity of share that we own for this particular CBA holding. So in years to come, when you sell even more of this holding, and the ATO want proof on how you calculated all of those capital gains for the last several years, the record keeping is critical to keeping you out of trouble. And when you know it's all here within Navexa, it means that you don't have to worry about that, because at any time you can come and check it out all here. Now, the same thing applies even though these are dividend reinvestment records. Imagine if you were dollar cost averaging into this particular holding every month. That's 12 transactions a year, 36 transactions over a 3-year period. It's a lot of things to keep track of, and that's why record keeping is super important. The fifth mistake is assuming your broker will handle everything. So if you've logged into your broker lately, chances are you've seen nothing about the dividends you've earned this year, let alone the dividends you've earned over all time. And when you come to look at your performance, you'll realize your performance isn't annualized either, which means it's not factoring in time. And as you could imagine, a 50% gain is better if it happens in 1 year versus 10 years. So if that's not factored in, every time you look in your brokerage account, it might say you're up 50%, but 10 years on, are you really up 50%? Definitely not. The dividend component part is really important as well, because how can you make smart decisions if you can't even see the return generated from dividends? So for example, some stocks are really good at paying a large amount of dividends, but they don't have much capital growth. So if you look at a price chart, a particular stock might look flat, or an ETF might look pretty flat, but if you factor in the dividend return, you see that it's actually making a significant return. It's just not in capital growth, it's in income. And that part is missing from every broker I've ever seen. The other part that's missing from brokers is the currency gain or loss. So if you are here in Australia and you've invested in some US stocks like Apple or Tesla, the currency movement between the US dollar and the Australian dollar can have a significant impact on your return. So even though you might be up in terms of capital gains, if you sold, you might actually be losing money due to the shift in currency. The opposite can happen as well. You might be making a loss on the stock, but the currency shift means that you're actually making a gain. So if you're not factoring in these currency movements when you go to sell, you don't actually know if you're making money or not until after you've sold and it lands in your bank account. So now we've covered the 5 most common mistakes Australians are making around ETF investing. Check out our next video.